Our next speaker is Sri Iyer from Braskem. He's going to talk about North America energy transformation and its impact on petrochemicals. Sri Iyer is the Vice President of Finance, Strategy, and Research and Development for Braskem America. Previously, he spent 5 years as a consultant with McKinsey & Company, and prior to that, he spent 8 years at ExxonMobil Chemical in the research and product development groups. Please welcome Sri Iyer.
I came here, I believe, last year and talked about shale gas and its implications for petrochemicals. I want to just preface these statements by saying this is a really interesting time both for energy and petrochemical markets in the US. We have historically not witnessed either the magnitude of the changes or the sheer speed at which these changes are occurring. We have, therefore, no guiding principles to figure out how and when to operate under these uncertainties. It's only 6 years back, everybody had written off the North American petrochemical industry as dead. That was an overreaction probably on the underside. 4 years back, 3 years back, the shale gas suddenly became a revolution. It became a gale. We overreacted on the upside. 4 years back, the US is going to be a net importer of natural gas going out into the future. An overreaction on the downside. And today we are talking about LNG exports and enough gas in the US to fuel us for 200 years. It's okay if we just hold these beliefs. Unfortunately, the US petrochemical and energy industries also put their money where their bias is. We have spent billions of dollars operating on what I'd call either positive or negative sentiments. So I'm not here today to give you any answers, only because I don't think there are any yet. Change is occurring, and it's still occurring. We do hear, obviously, from a lot of consultants about our ethane advantage in the US and how North America petrochemical is going to be advantaged forever and ever. The only thing I can state with quite some certainty is this is not going to last forever. The only question is when is it going to stop and who are the ones who are going to get their fingers burnt by investing in this revolution. So again, let me give you a couple of takeaways on both the natural gas and the crude oil industry in terms of what changes are occurring and what could be the implications for chemicals. I'm not going to come and tell you this is a great time to invest in chemicals or that it's a bad time either. Just that there's enough uncertainty for people to be a little wary, a little careful, have a more nuanced approach to this rather than things are going to be fantastic forever. That being said, I think I'm going to focus primarily, I think, on 3 topics. One is go over very briefly shale gas. We've heard about this now for 3 years. There's probably very little new that I'm going to add to this. But what's new, I think, is what's going to happen in the crude oil landscape. This is just beginning to hit our collective consciousness in the US. You've started to already see news reports that the US is going to be a net exporter of crude oil. Again, as I say, sentiments in the US swing so widely, it's amazing. We were going to be dependent on Middle East forever and ever in the early 2000s, and now suddenly we're going to be a crude exporter for time immemorial. So let's take that with a little bit of caution and see exactly what's happening. But there's an awful lot of uncertainty, and if nothing else, I just want to leave you with that. And finally, what are the impact on chemicals and polyolefins of all of these changes? Shale gas. Again, you can see here, shale gas is present all over the US. And its resource level over the last few years has actually gone leaps and bounds. In 2007, there was so little shale gas. It's not that it wasn't there. It's just that we didn't know how much of it was there. And just in the last 5 years, it's gone from being essentially not relevant to being today almost a third of our resources that we can exploit. All of this has happened primarily because of technology development. Shale gas, also our estimates have gotten better as we've tried to figure out where this stuff is. The good news for us is there's plenty of it, and it's all over the country. So if nothing else, again, just want to say, this looks like it's legitimate. There were arguments 3 years back, is shale gas here to stay or not? I don't think there's those arguments anymore. The argument is how big is it going to be and how long is it going to last? And how long are we going to have a period of quote-unquote low gas prices? Shale gas has actually grown, as you can see, from about 3 billion cubic feet a day to 16 now, a factor of 5 in 4 years. I'm hard-pressed to find a growth rate of that in the US in anything other than dot-coms. Certainly, the energy industry has never seen this. So again, as I said, the energy industry is still grappling with exactly how to deal with the situation. The sheer growth of this and the sheer speed have been so rapid, people are still really not sure how to deal with it, other than throwing lots of money behind it. Though the positive for us is natural gas prices in the US, which were, give or take, $8 to $12 in MMBTU, kind of on par with the rest of the world, have now fallen to about $3 in MMBTU. So the key question for all of us now is, what is the long-term gas price and how long is it going to last? You've got lots of people who are throwing out the number of between $4 to $6 in MMBTU, and they're throwing out numbers of 100 years. Not sure exactly which of these is true, but the 4 to 6 seems reasonable, again, today based on what we have. And what we have really is an idea of what is the cost of extracting this gas and how much do we think there is. This is really just a supply curve or a cost curve of gas. What's on the y-axis is the cost of getting it off the ground, and the x-axis is how large is it actually, how large do we actually think it is today. The dark blue being all the shale reserves. Again, our knowledge is still not complete. This curve could well change 2 years from now and show a shift of low gas further to the right, only because we're still discovering the extent of this quote-unquote revolution. But the news still really here is we've got about 30 years of production at current production rates at below $4 in MMBTU of full cost of extraction. Even if gas demand goes up, even if we start to move fleets into natural gas, there's still an argument to be made that says US natural gas prices will stay at about $4 in MMBTU for the next 10, 15, 20 years. I'm not saying the rest of the world is going to stay at 12, but as long as we stay at 3 to 4, as long as the rest of the world is higher than us, we have an amazing advantage in terms of energy cost over the rest of the world, which has its impact not just on petrochemicals, but has its impact on overall manufacturing. Any energy-intensive industry we are talking about here, whether it be steel, whether it be aluminum, whether it be chlorine, and you've actually seen investments happen in all of these value chains because of the promise of low gas going forward. What about on the demand side? Obviously, it's all a supply and demand game here. We have actually demonstrated that we can bring on incremental supply of about 2 to 3 billion cubic feet a day every year. And again, based on what we see in the shale gas and the extraction and the production, that appears to be reasonable. Can we actually grow demand that quickly? That's the question. It seems unlikely today. It's not to say it may not happen later, primarily because a large part of this really, you can retire coal power plants, you can have some regulations that trigger move to gas a little quicker. CNG vehicles, this is something that's being talked about today. Is this going to happen in the next 10 years? Absolutely not. Is it going to happen on a small scale? Probably yes. But we are yet to see the US develop potentially tens, potentially hundreds of billions of dollars of infrastructure to move to vehicles actually running on compressed natural gas. Certainly fleets are easier to manage, and that's possible. But even if we do manage to move 30% of the fleet vehicles to compressed natural gas, it doesn't make a dent in terms of the incremental demand or the incremental supply that's going to come from gas production. And what I'm talking about here is gas production just from shale gas reserves. When I move on to the oil story, there is, as people in E&P say, there is no such thing as an oil field. It's an oil and gas field. There's plenty of incremental gas that's going to come from our crude oil reserves based on light tight oil or shale oil that's going to add to this gas supply. So again, it's a good story for gas going forward. What is the current debate going on right now in the US? Again, as I said, back in 2008, the US industry spent somewhere between $40 and $50 billion building import terminals for LNG. Again, these were the days when we said the US is going to be importing gas forever and ever. Today, the utilization of those assets is less than 5%. In 4 years, we have just flushed away $40 to $50 billion of investment. What are people doing now? It's the very same players who are saying, let's spend $40 to $15 billion now on LNG exports. Again, as I say, the industry seldom learns. I mean, we go through these wild swings and also put the money behind it. But it's interesting. We have about 14 projects for LNG exports right now. Several coalitions that say this is great for the US because it reduces our balance of payment, certainly makes the gas industry very economical, increases their returns. It's not surprising when you're selling gas at $15 in MMBTU in Asia versus selling at $3 in the US, you would always export. A few companies, Celanese, Dow, are opposing this based on the fact that, no, you want to keep the gas in-house. So much for free markets, but the argument is we want to keep it in-house. But what's that going to do? Even if there is LNG export capability, even if people do build, what's going to happen likely to the price of natural gas in the US? It's going to go from what's an export price on a netback basis to the US. The US will still have a 5 to 6 to maybe even $7 an MMBTU advantage over other places in the world. Only because on a cost basis, it's still going to cost us $4 to get the gas off the ground and another $5 to transport it to somewhere else in the world. Again, as I said, these investments are not cheap. So the US will retain its advantage. The fear that some of these companies have is, will the local price be 4 or will it go up to 6? Because now global prices are at 12 and you subtract 6 and therefore we are at 6 now. That's a 50% increase in energy cost. It's a relevant objection, but again, as I said, so much for free markets. The chemical industry, if they say you've got to stop export of natural gas, is like saying the chemical industry has a right to high returns, but not the E&P guys. So we're forcing the, I guess, value transfer from the energy guys to us. Why is the story likely to change? We've been conditioned to believe that the US is unique in shale gas. This chart actually shows you how much shale gas resources there are in other parts of the world. And if you actually go down the list, you'll see the US is not one of the largest. We've been the most fortunate because we have probably the best system and the infrastructure and the legal framework to allow us to exploit it as well, as effectively, as quickly as we have. Typically, you can go to any farm owner in Pennsylvania, West Virginia, sign a contract for mineral rights and start drilling the next week. The legal framework is not as clear in a lot of these other countries where the governments own the resources, the landowners don't have any rights, etc. So does that mean the other countries are not going to develop it? I think the story is they probably will as technology develops in the US, as it's exported outside. A lot of the major oil companies are already looking for shale gas in Europe and in China. It probably will happen. It's a question of timing. So if we're at $4 an MMBTU, how long do you think it'll be before China comes to $4 an MMBTU? How long do you think it's before Mexico gets there, or Russia gets there, or Libya gets there? In other words, it could be a level playing field again. So for us, again, to sit here in the US and think we have this unique advantage that's going to last forever, I think that's being overly optimistic. But again, this is part of the uncertainty that we're living in today. And this could happen in the next 3 years, 5 years, or 15 years. We just don't know. But again, for us to start putting in money and these huge investments on the assumption that we are the only country that's going to have this is mistaken. The whole notion here is, how do we put out signposts? How do we track this to see at what point do we invest, at what point do we stop investing? That's the gas story, I guess, in short. The oil story is a little more interesting. It's new. It's not been realized widely yet. People obviously have probably heard of Bakken. Bakken is one part of where the shale oil or the light tight oil is coming from. As you can see, it's actually present all over the US. There was a news article yesterday, I believe, that the EIA said the Monterey Shale in California has more crude oil than the Bakken Shale. It has something, we are talking today based on our limited knowledge, I would say up to 50 billion barrels. But remember, we said the same thing 5 years back about shale gas when we thought what the size of the resources were. We said about 3 trillion cubic feet. Now we're saying 3,000 trillion cubic feet. Today we are saying 50 billion barrels of oil. What could that turn out to be 4 years from now? I'm not saying it's going to be 500 billion. All I'm saying is we just don't know because we are still learning. But this is actually quite enormous in terms of the implications. I would argue far more so than the shale gas revolution had on us. How quickly has this grown? If you look at shale oil production going back to about 2006, we had only 100,000 barrels a day. Today we are at 1.2 million barrels a day. And I would argue we're only just starting to scratch the surface. It's already 30% almost of the production of the lower 48 states. So it's become fairly significant. Let me try and put this in perspective. The US crude demand, give or take, is about 15 million barrels a day. It's the largest in the world, as you would expect. Our domestic production has been somewhere about 6 to 7, which means we've been importing about 8 to 9 from outside the US to meet our internal demand. Now, if you were to go back and look at what is happening to basic demand for crude oil products, the US and Europe, the absolute demand is actually going down. And if you were to look at ExxonMobil's recent energy trends report on their website, they are arguing that absolute fuel demand in the US is going to drop by 30% between now and 2030. Does that translate to a 30% decrease in crude oil demand? Perhaps it won't scale linearly, but you see what direction we are going in the US. Not only are we consuming less, but we're also starting to produce more. And this is what has given rise to news reports from IEA that US is going to be a crude exporter come 2020. Again, we don't know which way this is going to go, but again, interesting enough to know that if you were to look at where shale oil is relative to where shale gas was, what we've done here is really to plot on a normalized basis what is the production of shale gas and shale oil. And if you start at a common basis, shale gas in 2002 and 2007 and 2011, and if you look at light tight oil or shale oil, where it was in 2006, 2012, the trajectory of shale oil production is actually faster than shale gas. It's not surprising because they're really piggybacking off a lot of the technologies that have been developed. The key question is, where is this going to go? How far up is this going to go, and how quickly is it going to go? This is roughly, again, schematically giving you an idea of where these shale gas plays were and are actually today. If you look at the more mature plays like Barnett, Woodford, Fayetteville, there's a couple of newer ones like Marcellus, which is in the northeast, that's starting to become really huge. The shale oil plays are all right here. We just don't know yet which way they're going to go. But if you were to follow the same trajectory as the shale gas, at some point a lot of these could make it here in terms of where the mature shale gas plays are today. And the cost of production is really interesting here. The cost of production here is somewhere between 60 or 30 and 100. So let's call somewhere in the middle about $70. Today, crude Brent is at 120. As long as Brent is at 120, people are going to have an incentive to produce as much of this as they can. And that's going to start to put downward pressure on crude oil. And I'll talk about what the implications that has a little later. But again, just look at the cost curve. There's plenty of resources that can be produced even at $100 crude and even at a $60 or $70 crude. So what are the different estimates for how much shale oil is going to be produced? Again, there's a whole bunch of consultants. Everybody has their own estimate. The estimates range from, today we are at 1.2. By 2015, we could go anywhere from 2 to 4. By 2020, we could either stay just about 2, or we could go all the way up to 14. I want you to hang on to that number 14. 14 is what we produce from shale oil. 5 is what we produce from conventional resources in the US today. 14 plus 5, give or take, is 20. And our demand is about 14 to 15. So when you start to hear about estimates of US exporting crude oil, these are the kind of numbers that lead to us talking about that right now. It's not unreasonable. It just goes to show what is going to actually happen here going forward by 2020. Again, we could be at 6, but 6 plus 6 is still 12, and that's more or less balanced for North America, which has huge implications on a balance of payments. It has huge implications on global crude pricing. Again, I don't want to go through this in too much detail, again, to show these are the various scenarios of what US crude production could be. On the low case, it could be, from a shale oil, it could be 2. On a high case, it could be all the way up to 20. So 15 million barrels of shale oil production. The key question here is what impact is this going to have on crude prices? This is really global crude oil capacity and demand. It's a fairly busy chart, but I just want to kind of leave you with a couple of takeaways. The light blue line here and the dark blue line here are what we think global demand is going to be going forward. The gray area here is what we think light tight oil growth in the US is going to be. Again, I'm not talking about the similar kind of growth in other countries, and that's certainly a possibility even today. If the production is as large as we think it is, and if this is the global crude demand, you're going to see an impact on global crude prices where you're suddenly talking about $60, $70 crude globally. Again, this was something that was unthinkable 2 years back when we reached $140 crude. Again, this was the world of permanently high crude prices. Now, what's the implication for this? Ethane is cheap today. We heard Nick talk about it earlier today. Now, ethane's advantage is only relative to the marginal naphtha producer in the world. Now, ethane has an advantage as long as crude is about 90, 100, 110, because that's what gives you the cost differential of what a naphtha producer has and what an ethane producer has. If crude drops to 60, And given the fact that naphtha also gives you a lot of the byproducts that ethane does not, which are the C4s, the aromatics, the ethane advantage, even though we have plenty of ethane in the country, could start to vanish. Again, Nick talked about 10 million tons of capacity coming on in the US. Each million ton is a $4 billion investment. That's about a $40 billion investment for US petrochemicals. It's very clear that the first 2 to 3 investments are going to return their cost of capital. It's pretty likely that the last 2 or 3 are probably going to lose their shirts on this deal, especially if we think crude oil comes down back to 60. So again, every time we look at the world in absolute terms about there being a permanent advantage, you've got to throw in a bit of caution and say, what happens if light tight oil develops? What happens if crude drops to 80? What happens to all of the incremental, the new ethylene capacity that comes online in the US that had assumed crude was going to stay at 120, and suddenly, by the way, it's at 70. So the message here really is speed is of essence. The first 3 guys who actually build this and start operating it will probably make their money in the 6 years. And thereafter, if the world looks tight, great for them. But if it doesn't, they're still okay because they've returned their cost of capital. What about impact? Again, I'll go through ethane fairly quickly. I know you're going to hear about it right after the break. Nick talked about it as well. But it's a great story in ethane. We've been consuming about 1 million barrels a day of ethane. We've been producing about 1 million barrels a day of ethane, a little less than that. If you were to believe the projections as we know today, there's probably going to be 2 million barrels a day of ethane. That's twice the consumption. Now, ethane has no use in the US other than petrochemicals, which again explains why we are building 10 million tons of capacity. We have to find a way to consume all of this ethane. Even if crude prices do not come down, and here's the other uncertainty, which we still haven't really given a whole lot of thought on. Even if crude stays at 100, the additional uncertainty is at some point we're going to be building capacity so quickly that we're going to consume all available ethane. Now, back in the day when there was just enough capacity to consume ethane as there was supply of ethane, ethane essentially traded at parity to naphtha. Ethane had no advantage. Just because of the fact that there's no use for ethane doesn't mean ethane is advantaged. The only reason ethane's advantage is because we're producing so much more than we know what to do that the ethane producers essentially have to push it out of the market. If now there's enough capacity to consume ethane that it equals even the high production of ethane, ethane prices are going to rise back to their naphtha equivalents. Guess what that does to the investment returns of the folks who build an ethane cracker based on it having an advantaged ethane price? So again, going back to even if there's no crude uncertainty, the early players who build and start their plants in 2016 and run it for 5 years are likely to have an advantage. The guys who come in late to the party are at high risk. The other implication is we're obviously building, but we're building not for domestic demand. Nick showed domestic demand is not going up as high as supply is. We're really building for global export markets. Today we're exporting, I would say, about 20% of ethylene derivatives. In other words, we are running 90-95% utilization because we have such a cost advantage that we're actually exporting products. So we have changed, in a sense, our investment thesis in the US, which earlier used to be you build for domestic consumption, to now we are building for export demand only. It's actually a good story if you would look at PE prices. So far, PE prices, even though there's been excess capacity, if you look at export price versus domestic price, the green versus the red, they've been more or less on parity. So we're exporting 20% of polyethylene, but our domestic prices have not necessarily fallen. But if we add 10 million tons more capacity and demand only goes up by 1 million tons, the overhang is going to be a lot higher. The competition for us, for each of the players to actually fight for domestic markets is going to get a lot higher. What's that likely to do to the export versus the domestic prices? It's likely going to diverge going forward. It's possible that all the players here go out in an all-out price war and beat each other up. It'll be bad for everybody, but that's certainly a scenario to look forward to. At least for those of you in this audience who are buying polyethylene, it's a great story. For those of you in the audience who are selling polyethylene, this may be not a great story. How about the other NGLs? Focused on ethane, I want to kind of switch real quickly before I conclude my talk to propane and propylene. What the shale gas has done is produce not just ethane, but is to produce propane, butane, and pentanes plus, which is really natural gasoline, which is really, in a way, really like naphtha. We produced it, again, to an extent where we don't know what to do with it, to the point where we're now starting to export it. So those of you who followed propane markets, and again, Nick showed that in his ethylene economics, propane is now about equally advantaged to ethane in cracking. Not because propane does not have alternate uses, because we have far more propane in the US today than we know what to do. And so propane prices have fallen to a point where they're almost equivalent to ethane. If you look at propane pricing historically, again, it's a fairly messy chart, but I'll try and walk you through it quickly. The black are the propane pricing historically. The red is what you would expect propane pricing would be if people used it on an equivalence to naphtha in cracking. In other words, a cracker every day would make a decision, say, should I buy naphtha, should I buy propane? If I'm indifferent, the cost or the prices should be the same to me. And that's how the US market was, I would say, all the way up to the time the shale gas actually started to hit, up to about 2009. Now what has happened? The black line has diverged from the red line. There's far more propane that crackers can take. Unfortunately, there's not enough demand for propane in the US, which is forcing us to look for export markets, but there are export bottlenecks. So propane's at a huge advantage today. But again, no opportunity is going to stay on the table for too long. So there are people looking at propane exports. There is obviously today the outlook that as the shale gas develops, there's going to be plenty of ethane and there's going to be plenty of propane. Now, for this plenty of propane, the only thing you can do with it is to export it. And so companies like Enterprise and Targa and Phillips are actually looking to export propane. What is that going to do to propane prices in the US? Today, they're at a low. It's likely they're probably going to go back up, but they'll still be lower than global propane pricing. The US historically, and let me quickly switch to propylene because I think this is an interesting story for the polyolefin world. Historically, the US has always been relying on either refineries or naphtha crackers for propylene supply. We've never actually looked at propane to propylene, which is the on-purpose propane dehydro, only because the economics have never justified it. On the flip side, in the Middle East and China, they've built propane dehydro because the economics worked. They did not have as much propylene in those regions. Historically, if you were to look, these were the propylene to propane spreads. The dotted line is about $300 a ton. That's roughly what you need to justify a new investment in a PDH unit. If you were to look at all the way at the time period from 1990 to 2003, the economics never justified it. No surprise, nobody built a PDH. Starting about 2005, this started to actually open up, right about the time that Petrologistics came out and built their unit. Now, you can always debate whether they were smart or whether they were lucky. It really didn't matter. They did extremely well because they timed their production to come right on time where these spreads opened up. What does that look like today for US propylene production cost? If you were to look at, okay, refineries are slowing down because there's not enough gasoline demand. People are pushing naphtha out of the crackers because ethane makes a whole lot more sense. Therefore, there's not enough propylene coming. Refineries are not producing as much propylene. PDH is really the way to go. And if you would look at a cost advantage of North America PDH based on propane pricing versus alternate sources of propylene in the world, you have a price differential of, I would say, anywhere from $200 to $600 a ton, enough to justify capacity. Again, this depends on us having a propane advantage or propane staying at current prices relative to the rest of the world going forward. But again, as I said, this hasn't stopped anybody because for those of you who are following the propane dehydro world, there's been several new announcements. Dow has announced one, maybe two. Enterprise has announced one. Formosa has announced one. Petrologistics is looking at one more. Williams is looking at one in Canada. Typical North America petrochemical behavior. You see a good thing and everybody jumps in. Somebody is going to lose their shirt, but for those of us who are buying propylene, it's actually a really good story. Because you walk in when the dust has settled, and propylene is going to be pretty advantaged in the US relative to the rest of the world. This is a case, again, this could be heresy now in this audience here. We've been thinking of polypropylene as being essentially a stable and a mature polymer to sit aside and put all your investments in polyethylene. If this advantage continues, could we look at polypropylene as the next polyethylene? In other words, you build on-purpose propylene and polypropylene just for export purposes. So in other words, are we going to start to see the same investment in polypropylene as we do in polyethylene going forward? IHS seems to think so. Nick didn't talk about polypropylene, but we just got this data from them. which is they actually look at the US scenario and see there's going to be potentially a lot of new capacity additions coming up in the US. Only because you look at the same scenario that we do today. Plenty of propane, propane to propylene is cheaper than the rest of the world. Instead of exporting propane, let's just export it in the form of pellets and polypropylene. Again, as I said, this is a really attractive scenario now. The first 2 to 3 guys are going to do really well. It's a matter of debate as to how the rest will do and when this will die down. Thanks for your attention. Happy to take any questions if there's time. I know we're late for our break.